So, when you ask one of the greatest investors for all time, who has since passed away, about investing, his answer went something like this.
Well, yeah, buy and hold for a stock is one thing. Buy and hold the U.S. stock market is quite a different one. What do we have going for us in the U.S. stock market? Leaving aside how hard it is to pick the winners, how few people really ever heard of Amazon 25 years ago, to say nothing of Google, maybe a little more than that, maybe 30 years ago. So if you hold the stock market, you will, not to be corny, Bill, but you will grow with America.
So, it sounds simple, right? Just buy the S&P 500, sit back, and wait. No need to pick individual stocks or spend your weekends poring over financial statements. But is it really that simple? If you had invested in the S&P 500, you would have enjoyed an impressive average return of about 13% per year over the past decade, right? While this approach may seem appealing, given that US stocks have had a strong performance and significantly outpaced international markets since the 2008 financial crisis, there is a problem. What if this outperformance has not always been the case? And what if historical data from the past 4 decades reveals that domestic and international stocks moved in a cycle of alternating outperformance? So let me explain. The United States is home to many of the world's top companies, right? And it's no wonder that American financial experts frequently highlight the value of investing in the S&P 500. While this advice is certainly valid, there's an important aspect they might not mention, and that is the cyclical nature of market performance. And before we delve into the data, let's see how this works. The S&P 500 represents about 54% of the total global stock market value, while international stock markets account for approximately 46%. And what many investors may not realize is that nearly 75% of the world's companies are based outside the US. And according to data from FactSet, nearly half of the sales for the S&P 500 companies comes from other countries. And even though this seems to indicate that owning US stocks provides plenty of international exposure, it is maybe not exactly the case. So let me explain. Although American stocks hold a significant share of the global market, investors who focus exclusively on US stocks might miss out on diversification and growth opportunities that international markets can offer. Diversifying investments globally can help mitigate the risks and tap into the potential of thriving markets outside the US. Now, you might be thinking, wait a minute. Didn't Warren Buffett and Jack Bogle recommend just buying a low-cost S&P 500 index fund? And you are right, they did. The idea is to constantly invest in this fund through thick and thin, especially during market downturns. But here's the question we need to ask ourselves. Is this strategy as diverse as we think it is? And would you invest differently if there were a better approach? So let me explain. The S&P 500 has undoubtedly been a strong performer historically, but it's not the whole picture. It represents about 80% of the investable companies in the United States, but it's primarily composed of tech-heavy firms. And yes, these companies have some really strong performances over the last decades, right? But there is a problem. This concentration can lead to a lack of diversification, potentially exposing investors to sector-specific risks. What do I mean exactly? Many investors unknowingly fall into the trap of home country bias. This means they tend to overexpose themselves to domestic market risk by primarily investing in US stocks. It's a common phenomenon, but in today's internet-connected global economy, it might not be the most prudent approach. So let's take a closer look at the hidden risks of domestic overexposure. Do you remember General Electric? Once a symbol of American industrial, GE faced significant challenges in recent years. The company, heavily reliant on US economic trends, struggled to adapt to shifting global markets. And in 2018, GE was removed from the Dow Jones Industrial Average after more than a century, highlighting how even giants can stumble when overly dependent on domestic factors. This case study illustrates a broader point about the S&P 500. Technology stocks make up over 25% of the entire index. There's a significant chunk of your investment riding on one sector. Think about it. If tech faces a downturn, a quarter of your portfolio could take a hit, right? But it's not just about sector concentration. The S&P 500 has another hidden risk. A handful of tech giants dominate its value. Companies like Apple, Microsoft, Amazon, and Alphabet account for a disproportionate share of the index. This concentration means that the performance of just a few companies can dramatically impact the entire index. Now, you might be thinking, but these are global companies, right? Doesn't that give me international exposure? Well, yes and no. It's true that many S&P 500 companies have international operations. In fact, nearly half of the S&P 500 company sales come from international markets. However, these companies are still primarily influenced by US economic conditions and market sentiment. You are not a substitute for true international diversification. But let's be clear, the S&P 500 has performed well historically and has returned an average of around 9% per year over the long term. That's impressive. So consider this. The global stock market leadership has historically alternated between the US and international markets. There have been periods where international stocks outperformed US stocks. For instance, international markets had greater returns in the beginning of 2002 and again in 2018. This suggests that relying solely on US equities might mean missing out on significant growth opportunities elsewhere. But timing these rotations is difficult, nearly impossible. This is why it may be important to have both US and non-US exposure in an equity portfolio. Investors underexposed to foreign stocks could miss significant gains when markets overseas rally. Or investors could suffer losses when US stocks decline more than international stocks. So now you know how the US and international markets work. So let's break this down a bit. When we talk about international markets, we are looking at two main categories: developed markets and emerging markets. Developed markets include countries like the UK, Japan, Netherlands, or Germany. These are established economies with robust infrastructure and regulatory frameworks. On the other hand, emerging markets like Brazil, India, or China are transitioning towards the developed status. And here's the catch: they offer rapid growth potential, but it usually comes with higher risks. So now you might be thinking, okay, but hasn't the US market been outperforming international markets? Well, yes and no. While it's true that the US stocks have had a strong run in recent years, history shows us that market leadership tends to cycle between domestic and international markets. So let's take a look at some specific examples. In 2018, for example, when the S&P 500 was down 4.4%, some of the best stock market returns came from unexpected places. So the S&P 500 did outperform the international markets for the last years. But will this continue? And this is really important. It's not just about potentially higher returns. Investing internationally also gives you access to global leaders that aren't available through US stocks alone. Think about companies like Nestle, the world's largest food company, or Samsung, a leader in electronics and technology. Consider Toyota, for example, one of the world's top automakers. These are all powerhouse companies that you would miss out on if you only invested in the US stocks. One of the most compelling arguments for internationally investing, particularly in emerging markets, is demographics. Many emerging market countries have young, growing populations, which can drive significant economic expansion. Compare this to many developed nations, including the US, which are grappling with aging populations and slower growth rates. Take India, for example. It's projected to become the world's most popular country with a median age of just 28 years. This young workforce could potentially drive decades of economic growth. And China, despite concerns about aging population, still has a massive consumer market that is increasingly middle class and tech savvy. But it's not just about population. Emerging markets are also seeing rapid technological adoption. In some areas, they are even leapfrogging developed markets. Just look at mobile payment adoption in China, for example, or the booming tech scene in countries like Estonia. Do you see how important this is? We have seen the potential benefits of international investing, so we definitely have to keep it simple and do just one thing like financial gurus like Jack Bogle mentioned. But here's the thing, one of the most effective approaches is investing in international low-cost ETFs. And guess who set up these international ETFs? That's right, Jack Bogle himself. These ETFs, such as those from Vanguard, offer broad exposure to international markets, spreading your risk across thousands of companies. It's like casting a wide net instead of trying to catch one big fish. Now, you might be wondering, how much of my portfolio should I allocate to international investments? Well, Vanguard, one of the largest investment management companies, had some interesting recommendations. They suggest that at least 20% of your overall portfolio should be in international stocks and bonds. But here's where it gets really interesting. They say a more optimal allocation is around 40% for stocks and 30% for bonds. So that might sound like a lot, especially if you are used to US-centric portfolio. But remember, the global market is constantly changing. What works today might not work tomorrow. By diversifying globally, you are positioning yourself to capture growth wherever it occurs. So if you take this approach, you are not fundamentally changing your strategy, you are just optimizing it a bit. How do you actually go about building a globally diversified portfolio? Here's a step-by-step approach. First, assess your current portfolio. Look where your investments are concentrated. Are they mostly in US stocks, large cap or small cap, tech heavy or spread across sectors? Secondly, identify the gaps in your international exposure. Are you missing out on emerging markets, for example? European blue chips, Asian tech companies? And the third one is gradually increase your global diversification. You don't have to make drastic changes overnight. Start by allocating a small percentage to international investments and increase it over time. And consider using low-cost index funds or ETFs that track international markets. These provide broad exposure without the need to pick individual stocks. So here's the thing. It's always better to start investing than to worry too much about perfect diversification right off the bat. So keep it simple. When you are doing this, you are already ahead of the game if you're putting money into the stock market, even if it is just in the US stocks. But if you are the type who wants more diversification and want to profit from cycle of the outperformance between domestic and international stocks, you might be facing a common problem. What exactly should you buy internationally? Plus, there's the challenge of actually accessing these international markets. It's a lot to navigate, right? So if you are curious about specific ETFs that can give you the international exposure without the headache, you definitely have to watch our next video. We will break down some of the best international options at this moment to help you go global with your portfolio. See you in the next video.